Business Growth webinar series. This morning's webinar is the Irish Funding Gap, Smarter Ways to Fund Your Business Growth in 2026. Today, we'll cover why traditional bank funding often doesn't work for high growth Irish businesses, what funding landscape looks like, and how to structure your funding strategy to support growth. First of all, I'll introduce Kenor. So we are a firm of over 80 staff specialising in offering compliance and business support services, outsourced bookkeeping, payroll, management accounts. We are an award-winning online accountancy and company secretary practice, supporting SMEs across Ireland, Northern Ireland, and the UK. So I am standing for Christina today. My name is Claire O'Donnell, and I am the Client Services Manager here at Kenor. My team and I support clients from that initial inquiry through to catering a customised delivery plan based on their needs and continuous relationship management, supporting clients alongside our delivery teams. So this morning's session is supported by Finance Fair, an Irish-owned specialist in flexible funding options for SMEs. Their mission is to empower businesses to scale on their own terms, offering innovative, flexible, non-dilutive funding that grows with them. Aligning with our clients' momentum, we unlock sustainable growth and pers- preserve ownership, and help turn bold visions into lasting value. Joining me today as our expert guest is Gary Holligan, Head of Business Growth at Finance Fair. So I'll hand over to Gary shortly so you can sort of get your slides ready to share there, Gary, if not already. Gary is a highly accomplished business leader with a proven track record in business expansion, strategy development, and revenue generation. He works closely with funders and executive teams to secure the right funding solutions for scaling businesses. It's important to note that this webinar is for general information purposes only. For specific advice, we always recommend reaching out directly to an expert, and we'll share our and Gary's contact details at the very end. That being said, Gary and I are happy to take questions, and we'd like to see interaction from you throughout. So please use the chat or Q&A feature, and I'll pose your questions on your behalf towards the end. But now I will hand over to Gary to begin.
Thanks very much. That's a serious introduction, so I have a lot to live up to. But I really appreciate the opportunity to join here today. And what I wanted to talk generally at the beginning about was just the landscape. Can you see the screens and can you see everything sharing there? Okay. Um, so what we see, so yeah, I represent Finance Fair. I'm the head of business growth here, and that essentially covers new business development, brand endorsement, and really spreading our funding model and message of how we fund and the unique way in which we do it nationwide. And we've been in business for the last 10 years. We support about 110 companies each month with funding from our platform. And we're always looking for more companies as we want to grow ourselves. We're an Irish business. We were founded by Peter Brady and Helen Cahill I suppose, at the back of the financial crash back in 2013, 2014. As everyone on this call will no doubt know, the crunch that happened in both business and personal uh, financial services infrastructure kind of put everything on hold for a lot of businesses, but yet businesses kept going, and there was a need in the market for funding and funding Irish businesses. So the company was set up. It was set up as a platform, a funding platform. And what it did was connected the capital market, so European funds who saw Ireland as an opportunity for growth into the future. And coupled with that, I suppose what was happening as well was the rise of fintech. And that really, like what that actually means is that the banks, as we traditionally knew it in financial services, were sort of a cradle to grave provider. So they provided your first account, your first current account, your first car loan, your first mortgage, your first personal loan for our wedding, your pension, your retirement. So it covered absolutely everything. And what fintech started to do at the time was, because banks were closed, essentially to try and get their house in order at the time, fintech started to unbundle the larger providers, so picking individual parts of the traditional banks to specialize and provide expertise. And what it meant was, like for a company like us, you could effectively create a single expertise in one area. And I'll go on to the next slide in a second, and I'll just show you what that has, where the market currently is and what it looks like as a result of that. But what I wanted to first of all do is set the context here around the funding gap as we see it here in Ireland. And what we do is we support the growth of SMEs right the way through, but we specialize in a particular stage of a company's growth. But what we have here is just on the screen is the journey that a typical business might go on from starting out as an idea right the way through to exiting or selling the business at some point in the future. And from a funding perspective, what typically happens is the company is bootstrapped to begin with. So the founder or co-founders, family and friends can typically uh, get that early investment into the business to get it going. Some customers start to come on board and opportunities start to open up. And what we see is that businesses are well served at the early stage. Once they get that kind of initial product to market or initial service up and running and start acquiring customers, you can start availing of government grants. There's startup ecosystems all over the country, hubs, different communities that will support the startup community. Microfinance Ireland will provide loans up to 25,000. You'll have a lot of angel investors. You can start engaging with Enterprise Ireland. So as you start to scale and grow the business, all of a sudden you have all of this access to grants and finance. So and energy, right, at the right stage. But once you get to the point at which you're trading maybe a year or 2 years, and this is nationally, this is sector agnostic. This is just Ireland Inc. we're talking about here. What actually happens is the options start to evaporate essentially. So we coined this stage here the scaling edge, which kind of mirrors the image of getting to the edge of a cliff and looking at a chasm because all of a sudden those options that were there at the very beginning for growth sort of start to change and don't exist anymore. So what companies often find themselves having to do is they might look for traditional bank debt or they might need to look at outside investment if they don't qualify for bank debt. So bank debt or traditional debt usually works off a balance sheet, usually works off EBITDA, 3 years profitability, which just doesn't suit an awful lot of businesses, particularly tech companies, which are thriving in Ireland at the moment. They have no assets, and therefore they don't qualify for the metrics that traditional sources often do. So companies in Ireland, what ends up happening is they tend to go down the external investment too soon, right? And what I mean by too soon is they're giving away part of their business at a very early stage to get that investment in. And what happens is you get the investment, so maybe you need 500,000. And what you want to do with that 500,000 is you want to invest in marketing, you want to hire a team, you want to expand into a new market, maybe the UK or the US. So you need to invest but you don't need all of that money up front. So what you want to have is, but you're on the hook for it from day one, and you end up with this energy in the business that accelerates the projections, accelerates the ambitions of the business, and so. While it's a very valuable source of funding, quite often because this funding gap exists in the market, um, companies are taking that too soon, or they don't qualify for bank debt, or if they do qualify for it, what happens is by getting a loan, you do get all the money up front, but you're kind of locked out from getting another loan until that loan is paid back. So whether that's over 3 to 5 years or 7 years, as you might get, actually you might get the immediate value of it. But if you're investing in constant growth, what you actually need to have is access to revolving credit, capital that you can continue to invest in the business to raise the value of the business, acquire new customers, increase the revenues. And therefore, if you do go for external investment, private equity or venture, actually the value of your business is increased and you haven't given away any of it. So you're in a much better bargaining position. And I suppose what often happens at this stage as well is that companies either decide that they can grow or else they sort of stall and they stagnate and they trickle along. Okay. So if you're a business operating B2B, what's going to happen is from the very first contract you sign with a customer, the likelihood is you're going to enter into some sort of a payment delay situation. So your revenue, your goods or your services are 30 to 60 days away from you. Okay. Now that's a funding gap of a totally different type. That's a lived funding gap that exists in the business. So you've employed all the capital, you've paid all the staff, purchased all the stock, you've delivered the goods and services, but now you have to wait to be paid. And you still have to run a business for that period of time. And that's like a ticket to the game in B2B. You cannot avoid that. You have to actually find a way to work around that. And what most companies do is they find a way and it becomes normalized that that payment delay exists in the business. So you just deal with it. Somebody in the office looks after it and they're paid, and it just becomes part of running the business. But it is a funding gap fundamentally that can prevent growth because your money is always ahead of you. And similarly to with tech companies who are operating in SaaS models, so that monthly recurring revenue, all the revenue from the contracts that you've agreed to is all in the future. And so therefore, when you're operating B2B across multiple sectors, you're constantly operating in this kind of working capital funding gap that exists. And with that in mind, that's why Finance Fair exists, because we identified that this is a core problem or a core challenge that has to be overcome. And our funding solutions remove that from the business entirely so that businesses can uh, carry on with growing the company. They're not having to worry about the balancing act of getting paid in order to take advantage. If they see opportunities to win new customers, to break into new markets, to increase the operational efficiencies of the company by hiring new people, investing in infrastructure, technology, etc., they can actually access capital from within their own receivables, from within their own revenue book to invest in that growth. It's non-dilutive, which means we don't take any equity stake or anything in the business, and we can enable companies to grow through that scaling edge, that gap that I talked to there, to get to that point where by the other exit and with 100% ownership, or they can start looking at external investment with a really strong and valuable proposition to offer. So I'll crack on here because this is what, to go back to the earlier point around the great unbundling of the banks, back in 2013, there was 13 banks, indigenous and international banks exist in the country. Currently, there are only three retail institutions that you'll see anywhere, that being Bank of Ireland, Permanent TS and AIB. And then you have this whole kind of menu of different options that you might want. And I think, from a customer looking for funding, or a company, should I say, looking for funding, going out into the market can look like this, can look like, Jesus, where do I go? And quite often you might just take the one that's maybe you understand the best, whether it's a loan or whether it's something in like an overdraft. But really, what we're talking about all the time with companies here, whether it's potential customers of ours or just generally, is it's about getting that fit for purpose funding. So, what is it that you're actually looking to fund, and what financial instrument is best suited for that? So, quite quickly, what you can do, you can start unpicking some of the options here, because perhaps what you want to do is get a working capital facility. So, you can come to the likes of ourselves, you can come to other providers, look at Grid Finance there, you look at Linked Finance, you look at other providers which specialize in working capital funding like we do. But maybe you need to expand and actually you need to invest capital in buying a premises at some point. Well, that's a commercial loan. So you do need to go to maybe a bank for that, or you might need to go to, other providers of commercial funding to buy the property. Then you might need to buy some fleet. So the best mechanism for that is asset finance, where you will actually purchase the asset and pay it off over a period of time. So what a really good debt stack looks like is it's actually diversified. It's not one loan where you're hiring people, paying for marketing, buying a van, and trying to also invest in the refurb of a property. And while that might seem off-putting to apply to multiple places, actually it's the best thing you can do and the best investment of time for your business because as you move through the stages of growth, you might leave one form of finance and take on another one. The more of a track record you build up in doing so, and obviously you have to repay it all, the more lucrative that will look the next time you go for funding along the line, and you build up a very strong credit record doing that. In Ireland, we tend to have this aversion to debt, whether it's a hangover from the financial crash or just a general, we like keeping things nice and clean, or we don't, whatever reason we have psychologically when it comes to debt. Actually, in European markets and American markets, they just don't even think about running a business without taking on debt. And good advisors within the company. So getting either having someone in-house, finance director or CFO that can do this business, having external advisors like Kinor who can come in and give you that advice around the types of instruments, introduce you to the right people, talk about getting your financial house in order in terms of preparing for a funding application. That's the most invaluable partnership you're going to have throughout the life cycle of your business, bar none. And I am biased because I work in financial services, so for 20 odd years or so. But but the truth is, I've seen it work so well across businesses, and the ones who lean into this and own it are the ones who thrive because they learn as they go, they become really savvy, they build relationships, they build a credit record, and when they come and talk to financial providers like ourselves and others, they're ready because they've built partnerships with the right people like Knorr and other advisors in the market that might be able to say, look, this is what you should be doing now. This is how you should fund. Because going right back to that funding gap piece at the beginning, you know, getting the wrong debt at the right time can prevent growth. While you might get excited about getting the cash into the bank, actually long term it mightn't be the right thing for you. So it's important that the funding matches where you are, and it's really important to have the right advice at that time.
Gary, I suppose it goes back to a conversation I had with a prospect in the last couple of weeks. They're stuck in that exact kind of pattern or loop that you've just described. They have a really well established business, but the credit terms with one of their customers or their customers changed a couple of years ago, and as a result of that, it has impacted the business long term, where that business owner is stuck in an overdraft that they can't get out of. And I suppose we worked with him to kind of take a step back and understand the steps that we can take and how we can support and helping him understand the figures, have the records and everything up to date to be able to see what his options are then and the long term. But his goal was to just get out of the overdraft. He said he's stuck, in that cycle of the money comes in, we look great on paper, but at the end of the day, we're still kind of, stuck in the overdraft, and it's a direct impact of the credit terms changing. So it's definitely very, very relevant and something a lot of business owners probably are experiencing.
Yeah, yeah, and like it's a symptom of B2B, And
Mhm.
if I move into the next part of it here, uh, this just talks about the work, so working capital generally, and sort of how we will fund and what we're looking for in companies. But to kind of answer your question there, like if somebody if a customer of yours fundamentally changes their terms, um, that the impact on the business, on a personal level, it can cause sleepless nights, cause a lot of
Mhm.
stress. There's a lot goes on, but then just in terms of running the business and taking advantage of growth, things start to plateau. So what we look at here fundamentally when we're looking at companies is working capital and revenue. Okay, so you made a great point there, which is the top line revenue can look really, really good, but the bank account, that recognized cash in bank position, there can be a disconnect between them. And we look to bridge that gap here at Finance Fair, and we do it by looking at the revenue model. One of the first conversations we'll have with companies is understanding that revenue model. So how do you actually, you're working in B2B, you're a year or 2 years in business, you've achieved, up over, you're touching nearly €1 million in turnover, you're 700K in turnover, you see a chance to double or treble that. You've proven the market. You maybe have a team, which you need to have more people in the business in order to take advantage. So you can see all the opportunities. You need money, but yet fundamentally in the business model, there's all this trapped liquidity in the balance sheet because there's work done and you're waiting to be paid. Or in the case of a tech business, they've signed all these contracts and they're elongated. The payments come in month to month to month over a 12 or 36-month period. So they're receivables in the business, and so we have a form of an invoice finance solution, which essentially funds invoices. So those payment delays that you talked to there, if the company goes from 30 to 60, that won't impact your business because we'll give you 90% of the invoice the next day. And that goes straight into your bank account. So regardless of when your customer might pay, you still have the value of 90% of that money the very next day. So you're not at the loss of any payment terms. Okay, you might have to pay a little bit more to us for it, but you do have the cash in the bank where it belongs and how you're doing it. So that we have a single invoice finance solution that looks at that. And then we have a revenue-based finance solution that looks after tech companies who can't get funding elsewhere. And what we'll do is we'll give them a percentage of their future revenues upfront. So what we might do is look at the rolling monthly recurring revenues of the business and give them a percentage of that on a revolving basis. So what they can do is open up a revolving line of credit against the future revenues that they're earning in the business. So between those two mechanisms, we cover a broad spectrum of sectors across the country, and we're able to offer facilities that are they're tech enabled. So we use open banking to connect into the platform. So you reduce the amount of paperwork that you might need. It also increases the decision time. So we're very responsive. We can give decisions very quickly, and ongoing monitoring and the administration that's required in running a facility is significantly reduced because you have access to the platform through your laptop. You upload your debtor book, you capture all your receivables, you request drawdowns, you can request limit increases, and it's all done in real time because we use open banking integrations into the accounting and into the bank, and we can do dynamic real-time assessments on companies and requests. So speed and access to finance are our differentiator in the market because ultimately we're giving funding. So what that means is that the funding gap that I outlined at the beginning gets removed from the business. There's no longer the need to wait to be paid in order to run your business. You can take that out of the business, and then you can continue to grow on your own terms as a result. We don't take personal letters guarantee as a rule under no circumstances. So even if business owners offer them, we actually wouldn't take them because what we look at is the quality of the company, the experience of the owner in the sector, and the team that they have around them and the advisors that they have around them. And then we look at the quality of the customers that they're winning. So a lot of companies in Ireland will have blue chip because of the ecosystem, the FDI ecosystem that surrounds, whatever sector you're in. The likelihood is if you're becoming successful, you will have a contract with a Lidl, a Tesco. If you're in the food production industry, you'll have, if you're in the tech, you might have a large multinational tech company on your books. Across the board, if you're in medical devices or medical equipment with the HSE, if you're in recruitment, you're likely to have contracts with large blue chips as well. So they're ideal for us, and because of that, we don't need to belt and brace on security by bringing people in to the business like that. So that's sort of what we do. In terms of the products. If I just go here, they're the different solutions. I think, I won't labor these too much because quite simply, when you talk to us, we look to understand the business. So the fundamental trading performance of the business, the future projected cash flow forecasts of the business, really important to us. And as equally as important as the team and the people and the experience and where they're building the business in, what kind of sector. The likelihood is we have oodles of data and insights and a network and information on it so that we can get really comfortable very quickly with the types of businesses that are trying to grow in different sectors. And I suppose finally, just what we need. Like this covers probably every financial institution, if I'm honest, of what you need to have prepared. And I would also say, like, no, from working with Knorr, this is where you guys really excel as well, in the production of management accounts, year-end financial accounts. So for businesses looking to apply with us, but just generally, these are the types of financials that you and your team should be preparing and should have access to. Your year-end financials are they're a mandatory requirement, I guess. You're going to have those. And we look at those simply to understand the past trading performance of the business. Management accounts are the most important because they're the real number. That's the live trading position. And I would always say, everybody on the leadership team in the business, the management team, regardless of their role, should be briefed on these each month. They should know that bottom line number. How are we trading? What's our cash position? How are we getting on? The dynamic in the business and the ownership of that provided through the management account production. So whether you do it in house or you use Knorr for that service, it's actually vital because that is the pulse of the business right there. The trading accounts are usually well out of date.
Well, I think that's the thing, isn't it? The year-end account is great to look back, but it's very retrospective. Whereas with up-to-date and accurate management accounts, you're looking at the here and the now. You can
Yeah.
make real-life business decisions. You know what the company's position is throughout the year, rather than waiting and retrospectively reviewing it. So it's definitely key, Gary, to have those management accounts prepared at any stage, so that you can, I suppose, keep up to date and make accurate decisions then.
Yeah, like 100%, like because that's exactly where your business is at month to month and should be informing everything you're doing. So we look for your debtors and receivables, and we'll also look at the cash flow forecast. Now, because we're funding growth and we want to work with companies who have growth ambitions, the cash flow projections are really important, and it's really important that they're conservative as well. And what I mean is conservative is in that they're real. So it's either business is happening or pipeline businesses that at such a stage you can, with a broad degree of predictability, say, look, we're going to win this business. Um, because that will dictate then the types of funding you need, the direction of the business, and the type of facility that you might get from us or others. But certainly from our perspective, what we like to do is provide a path to growth. So you might need 1 million over the next 18 months or 500,000 or 200,000 or whatever it might be. You won't need it all up front. The cash flow projections will allow us map out a path to that funding, which means that you can control the cost of funds. So it's on your terms. You draw it down when you need it in the business. Obviously, if you need it quicker, you can get it. Or if you need to dial it up, you can. And because we use open banking integrations, we can see in real time what's happening. We can't do anything, we can just see it, but it reduces down having to send the last 12 months bank statements on an email into us and we have to read them. It actually all happens in real time. And that's the tech that we use in the background to enable us to do things much quicker. So I'm just conscious of time. I think there's some lovely companies that we've been really privileged to support over the last number of years. Some have gone on to some really, really exciting things across multiple sectors. And you can take a look at, we currently have on our LinkedIn social channels, real growth story campaign where some of these customers have come back to talk about what they've done with the funding. So the most recent one there is Capture. And if you're in Croke Park over the summer, you might see where you go in and you tap for your pint. You don't have to queue. You just take it, and it has all the technology. And we were part of that. Really exciting story. And then across a number of others as well, that we've helped grow and scale through that funding gap that I outlined at the very beginning. So thanks very much for the opportunity. And I suppose if there's any questions come in, I'd be delighted to answer them if I can.
Excellent. Gary, thank you so much. It's been so helpful, and I suppose everybody will be going for a bit of inspiration from your LinkedIn to see those stories and the perspective of the business owner as well. So we do have a couple of questions, and you've touched on a couple of them already. So what funding is available without the personal guarantee? So you've touched on that already there, Gary. Next question is what funding may be available to support us to establish our Irish operations, including product manufacturing here in Ireland?
Okay, yeah. So once a company has an Irish registered company here, so there can be international companies based over here, um, and they're trading. So they're a trading entity as opposed to a holding company. We can get under the hood of the revenue model, what they're generating here in Ireland, the types of contracts that they have. And as I say, our minimum deal size is 250,000, going right up to 3 million. And some of our companies that I listed there have exceeded that, but that's typically the size. Our average deal size is probably closer to about 350 to 400K on average. But I'd say we would have a dozen or so companies each month here taking funding off the platform who have facilities much higher than that. Um, Once the operation's up and running here, I suppose that's the main point to make from Finance Fair's perspective. So once they've got customers, they've got revenue generation in the business, we can talk. Yeah.
Excellent. Thank you very much. Another question is there seems to be no startup assistance for a new professional services company. Is this something Finance Fair can help with?
Uh, no is the short answer, and I suppose we're not in that startup space. We're definitely in that growth scale up part of the journey, and that's where we want to specialize in. As going back to the earlier points around unbundling and expertise, that's where we're experts in. I think where would I recommend going from that side of it? Like the local Leo, the local enterprise offices are a really good source of grant aid to get up and running in professional services. Microfinance Ireland do loans up to 25,000. So I would be recommending if it's at the very early stages of business that they're the connections and the partnerships you build. They have New Frontiers programs, they have SkillNet, so they actually can tap you into a huge amount of support, both financial and non-financial, that will help you start up and grow the business to a point where then you may be able to come to ourselves here once that customer book, once the revenue starts, your 2 years trading and the funding levels are getting to a little bit more increased stages. But that's where I'd be saying go to the Leo, look into Microfinance Ireland. There's a lot of grants out there for all sorts of training and getting set up, getting your tech, getting your phones. Like there's a
Yeah.
variety of them. Where I thought was really interesting, Enterprise Ireland have a website now called the Enterprise Hub. So if anyone listening hasn't checked that out, I would highly recommend it because it gives you the option to select where you are and what's available to you, and gives you all the contact numbers and everything in there. So that's worth checking out as well.
Some piece of advice there, Gary, and something that a good starting point for sure to know what's available and where. Just two more questions. I know we're kind of running over a wee bit, but hopefully your time permits, Gary. So just a question is, do you operate cross-border for Northern Irish companies as well, or is it just Ireland?
We do, yeah. So we're based in Ireland fundamentally, but we're also obviously cover the all Ireland, and where we're really unique in a way is that because our funding model, so people providing the funding on our platform are all international hedge funds, international banks, high net worth, family office funds. We've 23 fund mandates. Actually, geography and geographic expansion doesn't actually factor in here. We can fund companies who are based in Ireland or Northern Ireland who want to expand into the UK or into the US. And we can provide funding in those currencies. We can fund that global expansion without it impacting on any operational side of it. So some of our partners can provide the FX currency conversion, so you can trade in the currencies that you're actually doing business in abroad. So yeah, we're The companies do have to have an Irish base, an Irish registered company. That's kind of mandatory for us. But in terms of the expansion abroad or working cross jurisdictionally, absolutely no barrier there.
Excellent. Thank you. And just a final question. Is there already an outlook to the upcoming EU incorporation from your side? Have you any first impressions?
Sorry, ask me that question again. Sorry.
Is there already an outlook to the upcoming EU Inc. from your side? Have you any first impressions on that?
Not, I would say that we're our predominant, like the companies we're dealing with here are looking at growing predominantly in Ireland first. So that's in that growth stage. What happens beyond that is, companies will go to the UK, they might have a European base. But for us at the moment, you know what, look, the European markets, dealing with companies day to day, it's predominantly looking at Irish growth at the moment. So we're not really focused on what's happening in that space until it's comes down to how we might be assessing a company who's growing or expanding abroad.
Well, Gary, that is all the questions for you for
All
today.
right.
Thank you all for joining us and for that engagement. Hope you have found the insights into the funding landscape and smarter ways to fund your business growth helpful and practical. Big thank you to you, obviously, Gary, for sharing the expertise and guiding us through those strategies and what can help Irish businesses scale successfully. As a reminder, the information is for the webinar for general information purposes only, and for any specific advice to your business, reach out directly to Gary and his team or to the team here at Keno. We're more than happy to help. But thanks again for attending, for your questions, and for your time. I suppose we look forward to supporting you and your business journey and hope to see you at the future sessions of our business growth webinar series. Thanks, everyone. Thanks, Gary. Bye bye now.
Very much. Cheers. Bye now.
Thanks. Bye bye.